I find myself slightly sympathetic to the camp that at least cyclically, the US is in a decent position to avoid a recession. I think the key, as you touched on at the start of your intro, is obviously the inflation performance. And just as I was waiting to come on air, I was checking about some measures of inflation expectations, which I've looked at, throughout most of my adult career, as such, as you might call it. And what is interesting is they've remained pretty stable throughout the whole rise of inflation. So given that some of the forces that the Fed's been fighting are starting to fade, I think it's reasonable that certainly this mood and this response of markets is perhaps going to continue for a bit longer. But I don't say that with a huge amount of confidence, I have to say.
Do you think inflation in the U.S. is on the right track or downwards, on the glide path, really? Because we've had Secretary Yellen talk about how it would still take 2 years for inflation levels to come within the normal range, the Fed's comfort range of sub 2%. And what would that mean for the rate trajectory where most are pricing cuts at the start of 2024?
I mean, I'd say two very different things here in terms of, especially for markets. So I do think the trend on, or three things. I do think the trend on inflation is improving. In fact, I think the next twist is probably going to be more good news for Europe rather than the US, because we've had a lot in the US recently, and it's just sort of started in Europe. However, the second thing is, as pointed out by yourself, but also policymakers recently when they talk, core inflation isn't coming down that much, at least yet. And obviously, the whole reason why everybody's trained to look at core inflation is it's more stable and more indicative of the underlying situation than headline inflation. And that's quite a long way from 2%, which takes me to the third point, at least from my distance read. It looks to me like the policymakers have now shifted to a tone of saying, not quite sure what all you guys are looking at rate cuts for next year, because it's going to be a long time till we start cutting them. And I have to say, in order to deal with the challenge of core inflation coming down, and with it, the whole overhang of all the stimulus that's accumulated over the past decade plus, I think that's right. I don't quite get this view that rates have to automatically start coming back down again in order to have a permanently more balanced world, in my view, economically. We should be keeping rates around the 5% area in most of the developed world, because they should have some kind of positive relation to the level of inflation if we want it to be permanently stable.
Jim, let me just jump in and pick up on that sugar rush, because the growth in recent years has been aided by all of this stimulus, the fiscal transfer, and that has been put under many different banners, from helping customers and businesses around the energy price surge to ensuring energy transition and future-proofing. Now, the geopolitical layer as well when it comes to technology of the future. Should we have concerns, though, that we're running out of mileage here in terms of funding some of that stimulus? Because we've seen the reaction from a ratings agency stateside. We've seen even in the UK in the last 12 months or so what the debt profile can look like if there are big spending plans. Should we be worried that some of the fake stimulus that has bolstered growth is just not something we can rely on in future?
Going to be contradictory again. I think it's a pretty complex issue, really. Firstly, it's quite clear, and in a way, from a British or European perspective, it's quite amusing to see how much concern we often have about our level of debt to GDP when you look at actually what the rating agencies have got a lot of us to focus on as it relates to the US. And it's not stopped this administration coming up with enormous fiscal stimulus measures under various guises, as you nicely described. And I think certainly with the conventional mindsets my generation has got, and that goes to the core of how the IMF thinks about everywhere, as well as conventional thinking amongst many economists, it is clearly something for concern to that conventional mindset. Second thing, however, and here's part of the contradiction, I do think, given the very, very large structural challenges that many Western economies and arguably some others have about trying to grow productivity and boost productivity, and with it, be more ambitious for public investments, whether it be on the one hand, alternative energies to meet climate change, or in some other spaces. I think it's true to some degree in the US, certainly in the UK and Europe. There is an enormous infrastructure challenge to do with transport, the state of our preventive health systems, and in my view, some sort of redefinition of how we think about conventional fiscal policy, or what you might call a more sophisticated, financially market credible golden rule, where governments deliberately borrow more for investment areas where there is a really positive economic multiplier. I think that is what is needed, and to some degree buried in all the endless things this US administration has been trying to do. There is a bit of that, and I'd like to see more of that in Europe and certainly in the UK, because how else are we going to get out of this so-called low growth trap unless we do something like that?